and welcome to BQ Prime. India's Monetary Policy Committee decided to keep the benchmark repo rate unchanged at today's MPC meet. However, it has raised its inflation forecast for Q2 by 1 percentage point. Growth forecasts continue to remain the same. What it has also done is that the RBI has now asked all scheduled banks to maintain an incremental cash reserve ratio of 10% with effect from August 12th. To share his insights, we're joined by Dharmakirti Joshi, Chief Economist at CRISIL. Sir, thank you so much for taking time out today.
Happy to be here.
So to begin with, I'd like to know your first thoughts on today's policy. While it broadly seems to have been on expected lines, what did you think of the tone? The governor and the resolution did continue to emphasize that they are tracking inflation closely. So would you continue to believe that today's tone too was a little on the hawkish side?
Well, yeah, I think if you look at the June policy also, although the central bank did not change anything, neither the rates nor the stance, but they were very clearly communicating that one should not forget that their ultimate objective is to align inflation towards 4%. And that is what they're going to pursue. And this policy reiterates it even further. So what I read from the policy is that if you look at the forecasts of inflation, even by the first quarter of next fiscal year, it is at 5.2. So it is still not aligned to 5.2%. So what that means is that we should be prepared for rates remaining higher for longer. And we do not expect a rate cut in this fiscal year. Now, I think we believe that if weather doesn't play further spoil sport, I think we should see RBI cutting rates by the first quarter, which is April to June of 24. So that is one. And second, I think on the inflation side, well, it was expected that RBI will bump up the inflation forecast because the second quarter inflation pressure is too high, I think, particularly from the vegetable prices. But if you look at the trajectory of forecast, I think this is only seen as a temporary bump up because this is largely due to vegetables, which keep correcting which keep rising from time to time and then also correct because of their short duration crop cycle. So that, and then growth forecast they have maintained because the economy behaved the way they expected it to behave. And the first quarter numbers are very strong. I mean, from the high frequency data, whether it is PMI or it is credit, I think everything is pointing towards the growth momentum staying. So I think we do believe that the economy is on course for 8% GDP growth. Yeah.
Okay. Also, what are the expected implications of the incremental cash reserve ratio that's being imposed? Can we expect short-term rates to firm up a little bit?
Well, yeah, this move was a bit of a surprise because at least we didn't anticipate. But I think what they are trying to do is that using it as an evening exercise. I think right now the liquidity in the system is good. So because of the return of 2,000 rupee currency notes, now they want to take that excess liquidity out, which they intend to infuse sometimes during the festival season. Now, what this is going to do temporarily is it's going to raise the short-term yields a bit, but that is a transitory phenomena. It's not a lasting phenomena. But I think for those who are interested in the short-term movements, yes, I think there will be upward pressure on the short-term yields.
All right. So we'll delve a little bit into today's inflation forecasts. The RBI, as we discussed, raised the forecast for Q2 for inflation by 1 percentage point from 5.2% to 6.2%. That also means that the forecast for the full year has inched up by a little bit. So what are you making of current trends? Do you expect some respite over the next 2 months? And apart from vegetable prices, we have seen cereal prices, spices, multiple other food items see sticky and strong inflation as well. So what's the expectation on that front going forward?
Well, I think let's dissect the inflation a little bit. I think into three categories. The fuel part is what is showing low single-digit inflation right now. I think the only worry on that front is that oil prices have started rising. I think in the last 2 months, and I think if they rise further, I think they could again put pressure back on the fuel side. Otherwise, I think the fuel inflation is expected to remain benign because largely because of the base effect of last year. Now you come to core. Within core inflation, I think there are two parts. One is the core for goods and the other is core for services. Services core, we believe, will remain sticky because there is huge demand for services. As the governor was also pointing out, the PMI for services has been extremely high for the month of July. So I think that does exert pressure on services inflation. But goods inflation, because input costs have come down very sharply, the WPI, which is a kind of a proxy for input costs, I think is deflating right now. So that is also getting reflected in goods inflation. Goods inflation, by the way, was around 12% a year back. It is down to 4.8%. So it's come down very sharply. So that is the dynamics of the core inflation. Overall core inflation softening, but within that, I think the goods having a more downside than the services. Now comes the bugbear, which is the food inflation. And within food inflation, I think as governor also pointed out, the vegetable inflation is very volatile. It deviates a lot from its averages, and that is what we are seeing play out right now. But it also corrects because I think the crop duration cycles are shorter. So vegetable inflation is not that big a worry from the inflation perspective because it will correct. I think I'll be more worried about the cereals, the pulses. I think where the global and domestic factors both come into play, and we have seen that the prices have been stubbornly high, particularly in cereals. Pulses, they are rising because last year also we did not have a very good crop, and this year also the sowing is a little lower than what was last year. So I think pulses, I would say, is something that needs to be watched very closely. And I think then so this dynamics, I think where food inflation becomes persistent, I think that is the worry. Temporary food inflation, I think central banks do look through it, but if there are signs of its persistence, I think that is a cause of worry. Right now, I don't think there is any way to predict that. I think our base case is that it will soften towards the end of the fiscal year. But I think fingers crossed, because there are, as I said, there are many factors at play. El Nino can itself impact your palm oil production, rice production in other East Asian countries, and we import a lot of edible oil. So all these factors are to be watched, and I think as the risks play out or they don't play out, I think the policy will react accordingly, because we are all data dependent right now in this uncertain environment.
Absolutely. While the MPC continues to remain on wait and watch mode as far as inflation is concerned, on growth it does appear a lot more positive. Even real GDP growth for Q1 FY25 is projected at 6.6%. For the current year, we continue to see a growth projection of 6.5% from the RBI. So, as far as growth is concerned, would it be fair to say that things continue to look good?
Well, I think the data that is available till July is showing quite strong performance. The only problem is in the external sector, where goods export are negative. They have contracted for 5 months now, and the contraction is only getting deeper. The services exports are slowing. So I think that will create some headwind going ahead. But so far, I think the data doesn't show that has had any perceptible impact on the economic momentum. But yeah, it will play out going ahead, because the second half of the 23, I think the West will see a slowdown. China's recovery is quite uneven. So the the demand for our products will reduce from the external markets, and then that spills over to the sectors that produce those products. So there is some, I think, some headwind that we need to watch out for, apart from several risks, including geopolitical risks, which continue to remain in the radar of everyone.
All right. That's it at my end. Higher rates for possibly a little bit longer. That's the takeaway from this conversation with Mr. Joshi today. Thank you so much, sir, for taking time out.
Thank you for having me.